If your annual net profit is $50,000 and you file taxes as a sole proprietor, you'll end up paying roughly an extra $7,000 in self-employment tax. If your net profit is $200,000, your self-employment tax can shoot up to over $20,000, close to $30,000. Are you still using a sole proprietorship and still not sure what the differences are between a C Corp, S Corp, and LLC? I'm Mike, and today I'm going to break down each of these structures for you. Which one carries less risk? Which one saves more on taxes? So that you can start a business in the US safely and tax efficiently. If you're interested in the content on this channel, remember to subscribe and turn on the notification bell so you don't miss future updates. You're also very welcome to leave your questions in the comments. I'll collect them and answer them one by one in future videos. First, let's clarify these three concepts. What are C Corp, S Corp, and LLC? The first type is the C Corporation. You can think of it this way. In law, the company is an independent legal entity separate from the owner. It has its own name, its own bank account, its own tax ID, it can sign contracts on its own, and it can be sued on its own. If something goes wrong, in principle the company is responsible first. As a shareholder, the worst that usually happens is you lose the money you invested in the company. It won't drag down your personal house and savings. That's what we mean by limited liability. For tax purposes, a C Corp files its own corporate income tax return. The profit the company earns is taxed once at the company level. Later, if the company distributes that profit as dividends to shareholders, the shareholders have to report that dividend again on their personal tax returns. That's what people mean by double taxation. That said, when you hear double taxation, don't rush to conclude that a C Corp is definitely a bad deal. For some businesses, a C Corp actually has its own advantages. For example, if you plan to keep profits in the company long-term to reinvest, want to attract investors, or may issue stock, or set up employee stock ownership in the future. Whether a C Corp is right for you depends on a few key factors: the size of your income, the nature of your industry, and your growth plans. For this part, you really need to sit down with a professional accountant and run the numbers carefully to get an accurate answer. If you're interested in this topic, leave me a comment. I can make a separate episode just on when double taxation can actually be an advantage and what kinds of owners are better suited for a C Corp. S Corporation. This is just a change in tax status, not a different kind of company. What this means is that an S Corp is not a new type of company, but a way of filing taxes. So, in terms of legal status, it's still just a regular corporation. In terms of tax status, it chooses to use the S-type rules to file taxes, so it's called an S corporation. Legally, it is still a corporation. It just applies to the IRS to obtain S corporation tax status. The way it files taxes changes. It is no longer subject to double taxation, but becomes a pass-through entity, meaning the company itself does not pay federal income tax. Only the individuals pay income tax. 1. How is federal tax calculated? For federal tax purposes, it's a pass-through entity. I often explain this to clients in very plain language. It's a way of filing where the money the company earns is taxed directly on the shareholders. The company itself does not pay federal income tax. At the end of the year, after you subtract income, costs, expenses, depreciation, and other deductions, you get the company's profit or loss for the year. Then, based on each shareholder's ownership percentage, that amount is allocated to each shareholder. Each shareholder receives a K-1 and then reports the numbers from the K-1 on their own Form 1040 individual tax return. Careful viewers may have already noticed, there is no corporate-level income tax here. The company's capital gains or losses go straight into the shareholders' personal returns. That's why, at the federal level, there is only one layer of tax. 2. It's not about how much cash you take out. It's about how much is allocated to you on paper. There's an important point here that many people get confused about. In an S Corp, taxes are based on how much the company earned this year and how much of that is allocated to you, not on how much cash you actually withdrew from the company. In other words, even if you're very disciplined and leave all the money in the company to reinvest, buy equipment, or just keep it there without taking it out, as long as, on the books, it shows that this year the company has profit allocated to you, you still have to pay tax on that share of profit on your personal tax return. Let me give you a simple example. This year, the company earns $100,000. You own 50% of the company. On paper, $50,000 of profit is allocated to you, and it appears on your K-1. Even if you don't take out a single dollar of that $50,000 and leave all of it in the company, you still have to report that $50,000 on your Form 1040 individual tax return. That's what we mean by a way of taxing that goes directly onto the shareholders' heads. The tax is calculated based on the person first, not based on when the cash is actually received. I'm not sure if this example helped clarify things. If you feel it's still a bit confusing or hard to follow, you can leave a comment below and ask me, or email me your specific situation. Later, I'll pick a few common questions and make another video just to explain them. 3. S Corp eligibility requirements. Finally, there are some qualification thresholds for S Corps. Not every company can elect this status. The number of shareholders cannot exceed 100. In principle, shareholders must be individuals. Certain specific trusts or retirement plans can qualify, but with restrictions. Non-resident aliens cannot be shareholders, and certain entities are also not allowed to be shareholders. The company can only issue one class of common stock. You can't create a bunch of different share classes with different rights. These restrictions are exactly why some companies want to elect S Corp status. But as soon as the accountant looks at the shareholder structure, they say, in your particular situation, you don't qualify. The third type is the LLC, or limited liability company. It's a bit like a hybrid of a corporation plus partnership. 1. Legally, it has corporate-style limited liability. Let's look at the legal side first. An LLC, like a corporation, gives the owners limited liability. That means, if the company owes money or gets sued by a client, in general, the LLC itself is responsible first, and the members at most lose the money they invested into the company. It won't directly drag down your personal house and savings. That's why many small businesses, stores, and service providers like to use an LLC to wrap or contain their risk. 2. Management, more like a partnership, more flexible than a corporation. The way an LLC is managed is much more flexible than a corporation, which has to deal with boards of directors, shareholder meetings, and so on. There's usually less paperwork, and you can use an operating agreement or company agreement to lay out how everyone divides responsibilities, profit sharing, and decision-making. So, many people feel an LLC has the protection of a corporation, but in day-to-day operation it feels more like a partnership. 3. Federal taxes, LLC flexibility. Here's the key part. For federal taxes, an LLC is extremely flexible. First, single-member LLC. By default, the IRS treats it as a disregarded entity, which means, legally, you are an LLC and you have limited liability protection, but for tax filings, the IRS acts as if this company doesn't exist and looks directly at you as an individual. In practice, it works like this. All the money your LLC earns is reported on your personal Schedule C, which looks a lot like a sole proprietorship, with one key difference. A true sole proprietorship has unlimited liability, while a single-member LLC has limited liability. We explain it to clients like this. From a tax perspective, it looks like a sole proprietorship, but legally you have one more layer of protection than a sole proprietorship. Second, LLCs with 2 or more members. By default, they are treated as a partnership. The company files a Form 1065 partnership return, then issues a K-1 to each member, and each member reports their K-1 on their own Form 1040. It's the same idea of income being allocated to the individual. Third, you can also elect to be taxed as a C Corp or S Corp. If the business grows later on or the nature of the income changes, the LLC can proactively apply to the IRS to be taxed as a C corporation, or, if it qualifies, elect S corporation tax treatment. So, many people choose an LLC when they're just starting out. They begin with the simplest way of filing, like a sole proprietorship or partnership, and once the business income becomes more stable, they consider switching to S Corp taxation to save on self-employment tax. Legally, an LLC gives you corporation-style limited liability protection. For tax purposes, an LLC is very flexible. At the beginning, You can file in a simple way like a sole proprietorship or partnership, and later, once you're earning more, you can choose C Corp or S Corp tax treatment. Limiting liability. How do these three structures protect the owner? Common ground. All of them have limited liability. As long as they're properly formed, shareholders who are members of a C Corp, S Corp, or LLC are generally only liable up to the amount they invested. If the company owes money or gets sued by a customer, people usually go after the company first. They don't directly go after your personal assets. That's what people mean when they say, "I want to set up a company to separate the business risk from my personal assets." But limited liability is not a 100% guarantee. Don't let the corporate veil be pierced. Whether a court is willing to recognize that the company is the company and you are you depends on whether you yourself have torn this veil. If you treat the company like your own pocket, or the company is just an empty shell with no basic discipline, the court may say, "Sorry, this company is merely an extension of you personally," and then they won't be polite about it. They may go directly after your personal assets. So we absolutely need to do the following things. 1. Spell out clearly who contributed how much capital, how profits are distributed, and who has the authority to make which decisions. Keep your business and personal bank accounts strictly separate. Don't mix company money and household money in the same account. Use a company card for company expenses and a personal card for personal expenses. This is the most basic first step to protecting yourself. 2. All contracts, invoices, and leases should be signed under the company's name, not your personal name. As much as possible, sign as company name plus your title. 3. The company should have basic capital and proper insurance. It shouldn't be an empty shell. When you form the company, don't do it with literally no capital at all. High-risk industries should have insurance, like general liability, professional liability, etc., so that the court can see that this is a company that is actually operating and acting responsibly. Then they'll be more willing to keep that limited liability wall in place for you. 4. A corporation should hold shareholder meetings, board meetings, and keep minutes. An LLC should at least have an operating agreement. To put it plainly, as long as you don't treat the company like your personal wallet, the court is much more likely to recognize your limited liability as a real umbrella of protection. Federal tax rates. How are they applied, and where can you save on taxes? 1. C Corp. At the corporate level, the company first pays corporate income tax, 21% federal plus state corporate tax. After that, when it distributes dividends, the shareholders then pay personal income tax, double taxation. Advantages. Suitable for companies that plan to keep profits in the company and reinvest them. Suitable for companies that plan to raise capital, issue stock, and grow larger. 2. LLC. Single-member LLC, filed on Schedule C, similar to a sole prop. Multi-member LLC, filed on Form 1065 like a partnership, and K-1 is issued to each member. For the portion where members are actually involved in the work, usually the entire income is subject to self-employment tax, around 15%. The advantages are, it's simple, it's flexible, and you can use the 20% QBI deduction, subject to income and industry limitations that need to be explained separately. 3. S Corp. Also a pass-through entity, with no corporate-level income tax, and it can also use QBI when the conditions are met. The key tax-saving point is salary versus shareholder distributions. When the owner is both shareholder and employee, they must first take a reasonable salary. This part is subject to payroll taxes. Profit above that salary can be taken out as shareholder distributions, which usually are not subject to self-employment tax. That's why many consultants, freelancers, and small firm owners use an S Corp to reduce self-employment tax. You can summarize it in one example like this. With the same $200,000 of profit, an LLC, treated as a sole proprietorship, has to pay self-employment tax on the entire amount, which comes out to around $27,000 in tax. An S Corp can convert part of that into shareholder distributions, which only pay income tax and no self-employment tax. So you save that $27,000. But the catch is, your reasonable salary has to be high enough, or the IRS will come knocking. Special rules in California. I have many clients from California, and California's tax rules are a bit more complicated, so I'm going to use it as a specific example for understanding. 1. California C Corp and S Corp tax rates. C Corp. State tax is 8.84% or a minimum franchise tax of $800, whichever is higher. S Corp. In California, an S Corp pays a 1.5% state tax on its income, with a minimum of $800, whichever is higher. The good news is, for a newly formed corporation, in its first tax year, California currently waives this $800 minimum tax, giving you a bit of a startup buffer period. But starting from the second year, as long as the company still exists and hasn't been formally dissolved, whether or not it's making money, that $800 basically needs to be counted as a fixed cost every year. 2. Fixed annual costs for California LLCs. For any LLC that is registered in California or doing business in California, every year there is a fixed $800 annual tax, and the first year is not exempt. If your total California source income exceeds $250,000, you also have to pay an LLC fee, similar to a gross receipts tax, with tiers ranging from $900 to $11,790. So in some respects, an LLC is not the most tax-favorable structure. You should choose based on your own situation or consult your accountant. 3. An LLC can choose to be taxed as an S Corp. Many small businesses in California are legally an LLC, but for tax purposes, they elect S Corp status. In this setup, in California they pay a 1.5% state tax, with a minimum of $800, whichever is higher, the same as an S Corp. Sole Proprietorship. Next, I also want to briefly add one type that many people overlook, and that's the sole proprietorship. A lot of businesses start out as a sole proprietorship. You register a business name, open a bank account, and you're in business. No need to form a company or draft any agreements. It feels fast and cheap. However, it has two big problems. First, the liability is unlimited. Legally, you and the business are the same person. Debts owed by the business or lawsuits against the business can, in principle, go straight after your personal house, savings, and car. That's completely different from the limited liability we talked about for C Corp, S Corp, and LLC. Second, from a tax perspective, it's not necessarily the most advantageous choice. The net profit of a sole proprietorship, in addition to regular federal and state income tax, is also subject to about a 15.3% self-employment tax, which is essentially the Social Security plus Medicare portion, meaning you're the boss and the employee at the same time, and you pay both sides of FICA yourself. So if you're still running your business as a sole proprietorship and your income is already stable, there's a good chance that, in terms of both risk control and tax savings, it's no longer the best option. If you're not sure whether you should switch from a sole proprietorship to an LLC or to an S Corp, you can ask a professional tax advisor or accountant to review your structure. On the screen right now, you'll see my WeChat QR code. Feel free to scan and add me. I can help you do a simple checkup of your business structure and see whether there's an opportunity, under legal and compliant conditions, to lower your risk and also save some tax at the same time. Which structure is more suitable for you? It's hard to give you a definitive answer here. This really depends on your personal tax situation and on the development plan for your business. If you'd like to know more, you can send an email to my address, and I can create a customized tax strategy for you. What we talked about today is just general principles, not specific advice for your personal situation. Everyone's income, family situation, and industry are different, so before you make any decisions, remember to ask a professional accountant to run the numbers for you. If you're interested, in a future episode I'll break down some real-life cases, same type of small business, but comparing an LLC taxed like a sole proprietorship, an S Corp, and a C Corp. How big can the difference in tax be each year? If you don't want to miss it, remember to subscribe, turn on the notification bell, like, and share this video.